Right. So welcome everyone. My name is Kamal Manocha. I represent PMSAIF World. We have been doing pertinent webinars every Friday, and the world of investments is very dynamic. We have seen COVID. We have seen the fall in 2022 when interest rates started to go up. When Fed started to increase interest rates, and then we have also seen the highs of 2024, and subsequently after that, we saw time as well as price correction which happened over last 5.5 months. Welcome, Pankaj, to this Friday webinar. It
Thanks,
was
Tom. Thanks, Tom.
it was pleasure to kind of hear you talk very seamlessly. Saying that you do not kind of get perturbed when markets are down, because your portfolio style is like trying to ensure that neither you nor your clients, like our clients as well, have sleepless nights. And that was like something which caught attention, especially of those HNI, ultra HNI investors who really kind of connect to the same. And that is where they were wanting to do this webinar with you, especially now. It looks like market may have bottomed, and the last time when we were conversing, that was a forum which is our annual crystal gazing summit.
Sure.
And I would not want to add any bias. I want you to kind of maybe to do a free flowing sharing of your perspective and opinion, because we understand your background, and I know you do not need any introduction. You come from illustrious background of more than 2 decades. You have seen markets, valuations, worked in banking research, managed public money. You're founder of Renaissance. All of us understand that, but we want to understand from you straight away, where are we headed, how to navigate this bull run, what are your views, because I know I interview fund managers every Friday, and hence I also have some bias, but hence I want to understand from you in a total unbiased manner.
Sure, Kamal. No, I fundamentally believe that the bull market is very much intact, because 2 weeks back or 4 weeks back, when we had this correction, a lot of people were questioning the bull market. So I don't think so. In my mind, I have any doubt or question mark on the bull market. And the simple definition of bull market to me is, I go back to the 1910 Dow Jones theory, that on a full year basis, markets in a bull market, markets will give positive returns. Nifty 50 index, when I say market, I'm referring to Nifty 50 index, gave positive return of 9% last year, calendar year 24. And I continue to maintain that, which I've been saying. This year, Nifty 50 will again do a single digit positive returns. Yes, returns are modest because we have had an earnings slowdown. This year, ending March 25 or financial year 25, earnings growth for Nifty companies is 5%. The slowest earnings growth that we have had in the post-COVID world in the last 5 years. So in the context of the slowdown that we've seen in the economy, and that slowdown has translated into earnings slowdown, returns are modest, but I still think that the bull market is very much in place, and we'll still this year make single-digit positive returns. Probably next year can be better or higher returns. But even now, from the lows we had 2 weeks back, to make a single-digit return effectively means that markets will have to rally 15% or 18% from 22,000 to give 7-8% positive returns. So I think, if you ask me, and that is what I was saying then also, that we are closer to a bottom in the market. Now, probably in hindsight, we know that the bottom is in place. I think the outlook on equities continues to remain positive. The good thing is, in a world which is chaotic out there, I can tell you from my experience, this is one of those periods of the highest uncertainty that I am seeing. This is one of those 3 or 4 periods that I have seen in the last 26 years or 27 years of my working career, where we have had the highest level of global uncertainty. Because I'm not getting into too much of details, but whatever Trump at least is claiming to do or proclaiming to do, how much he'll do, we'll have to see. But what is proclaiming, he's trying to reset the clock back to pre-World War II days. So he's trying to reset the clock globally 70, 80 years back. I doubt he'll be able to achieve even 10-15% of his agenda, but keeping that aside, that has created an environment of extreme degree of uncertainty. And the impact of whatever little action he does or whatever he does is significant on a lot of economies in the world. Tariffs now, Mexico will actually slip into a recession this year because of the tariffs imposed by US on Mexico. I'm saying in that context, when you look, if there's US economy slows down or US slips into a recession, there's a fear that US might slip into a recession this year now post Trump's actions. A lot of export-oriented economies like Korea, Taiwan will suffer. their growth will slow down because these economies, a significant part of their growth comes from exporting to US. I think in this context, point I was saying then and I'm saying now, India is far better placed. We are an oasis in the desert. Even in where everything in the world is going so all over the place, India will still do about 6.5% growth this year, which is not bad. So all I'm saying is what we witnessed during last 5 months between September and February was a correction in a bull market. Yes, it was a very steep correction. The sell-off in mid and small cap was very sharp, but that also was the rally before that, where I think we had a sort of a mini bubble in mid and small caps because valuations were extreme. There was over exuberance. SME IPOs were flying through the roof, and all sort of things were happening. And somewhere mean reversion had to happen, which has happened, which is a good thing. All I'm saying is the outlook for India continues to remain pretty stable and steady in an environment globally where it's challenged. And now that the valuation correction has happened, it's a good time to put money to work in equities. Also, the last thing probably I just want to highlight for the benefit of everyone on the call. See, India is a high growth economy and Indian markets tend to do well, but Indian markets are one-sided market. So we get correction in Indian markets once in every 15 or 18 months. The last time we had a correction before this was between Jan 23 and March 23, when we had a Silicon Valley Bank issue in US, if some of you might recollect. And after that, we had a one-way bull market for 18 months. So all I'm trying to say is a correction in Indian equity market is extremely precious from an investor's point of view. That's a great opportunity. Don't miss that opportunity. Don't lose sleep over it. But at the same time, don't let go of that opportunity. Make use of that opportunity. I think this is the time to put money to work. Don't think. Don't discuss. Put money to work. अभी discussion मत करो. अब discussion का time नहीं है. अभी action का time है. So please put money to work. Have faith in India. India is still very well placed versus a lot of other countries in the world. So I have my, just to the last thing on this, when you said this, when I don't lose sleep, the only reason I don't lose sleep is two things. One, I have my eternal faith, just like we have faith in God. I have eternal faith on India and Indian equity markets, point number one. And secondly, वो जो हम बोलते हैं, उतना ही खाना चाहिए जितना हम हजम कर सकते हैं. So even when markets are doing well, we are very careful about investing. We do not invest into speculative companies, poor companies with poor fundamentals, and so on and so forth, because we own good companies in our portfolio. Stock price fall does not perturb me. What perturbs me is if there's a change in fundamentals of the companies. If companies are not doing well, if there's some corporate governance issues in companies in which I am invested, as long as those issues are not there, stock price तो क्या है वो आज ऊपर कल नीचे, meaning if fundamentals are intact and growth is intact, stock price will come back, and any fall is an opportunity to buy. So two reasons which I don't lose sleep on equities. Equity to me now is a too smaller thing to lose sleep. Lose sleep over precious things in life. One, I have eternal faith, and secondly, I am careful about my behavior in terms of where I'm investing or my investing discipline when things are going good. So then when things turn bad, you don't have to worry because you've done all the right things. So yeah, that's what I was wanting to say in that sense.
No, absolutely.
For investors, sorry, one last thing. SIP in mutual fund parlance is systematic investment plan. For investors' personal life, it's sleep in peace. Invest well and sleep in peace. You do SIP for yourself. Invest well and sleep in peace.
No, yeah. Absolutely. I agree with you. And it's like, I would say more to do with your own knowledge. And we also, are a firm believer of the same. Once knowledge, light, is there, obviously, the darkness, fear is absolutely reduced. It cannot go away. But that knowledge when that knowledge is backed by data and experience, of decades, obviously one is able to kind of sail through the dark phases like we saw in last maybe 5.5 months. Having said that, there have been fund managers who say that this time the recovery will be a W-shaped recovery, will not be a V-shaped recovery, and obviously we have seen markets have taken their own course. We have seen volatility. So you feel that you are quite confident that bottom has been made.
I am absolutely confident. I'm willing to stick my neck out. I've already put my money meaning my money is out there for not only for me, but all my clients as well. I firmly believe the bottom is in place for equity markets. And I firmly believe within this calendar year, we'll make a new all-time high for equity markets. Unless you tell me there will be a third world war. Unless you tell me that Trump will go and bomb Iran and start a new war in the world, which I don't, these are not my assumptions. So unless some of these outlier things which are completely unexpected happen, unless you tell me Trump goes and bombs Iran, oil price goes to $140, US, there's a big financial crisis in US, which I don't see on the horizon because underlying in US is pretty resilient and all that. I don't see any of these things happening. So unless any of these things happen, then obviously the assumptions might, or the view might change. But for this, which I don't see, these are not my base case assumptions. I certainly think Indian equity markets making a new all-time high within the calendar year 25. So I firmly, within that there will be sectoral rotations. Obviously, the leaders of this rally from here on now, the new rally that we start, will be different from the leaders in the last rally. So the last rally, the leaders were defense, cap goods, industrials. Probably the leadership will change, in my view, in my opinion. So leadership will change. But markets, the beauty of Indian markets, it's a very diversified market, 16 sectors, companies, in all the 16 sectors, you have companies across, we have hundreds of companies across large cap, mid cap, small cap. So you have a lot of choices, right? So we just have to position our portfolio well in terms of the future growth cycle, and which is where active managers like ourselves come into place. But directionally from an equity perspective, I'm absolutely of the opinion that we'll make a new all-time high within this calendar year.
Sure, Pankaj. So I would tend to agree with you. And you kind of, initiated the subsequent question which was on my mind. How do you think the next rally, which maybe has already started, which may have obviously continued volatility given the deglobalization and tariff, sentiment going around. But yes, in this entire challenging times, there will be new leaders that will emerge. So what are those leading sectors that you're looking?
The views are simple. The world, given US wants to, the trade war, we are in the middle of a global trade war in terms of whatever Trump is trying to do. The more lethal and dangerous wars of today's time will not be physical war between, let's say, whatever we've seen between Israel, Hamas, or Russia, Ukraine. I think the more lethal war, which will have significantly more impact or higher impact on the world, will be economic wars. And trade war is nothing but an economic war. So the world is in the middle of economic war. World is in the middle of a trade war unleashed by US. Trump has an agenda, and he thinks that's the path to achieve his end objectives. Right or wrong, whether he'll be able to achieve what does it do for US is a separate question. But it does have an impact on the world. So the world or global economies will have to get more insular, more domestic. Or we'll have to rest more on domestic factors to drive growth. And I think the same thing holds true for India. After a gap of 5 years now, for the last 5 years, since this bull market started in March 20 on the onset of COVID, I've been underweight consumer sector. Now my views exactly changed. I think the Indian consumer is the most exciting place to be in the world because there are demographic supporting. Income levels are rising. Some of the factors which were driving underperformance of consumption are behind us. From here on, I think one PFC, what we call private financial capital consumption expenditure, that growth over the last 10 year, 15 year is ahead of nominal GDP growth. So about 11% growth in the last 15 years in private final consumption expenditure. Last 3 years, that growth is down to 5%. So we are coming from a low base of consumption in India in the last 3 years. All of us know there has been a sharp consumption slowdown in India. I think that will come back very strongly over the next 3 years. The recovery to begin with will be modest and gradual, but it will really accelerate into the next year. I think we've just started the rate cut cycle in India. India has the highest real interest rates in the world. But I think we'll get at least another 75 basis points of rate cuts during the course of this year from central bank. So the inflation number positively surprised us last month, a few weeks back when we had the February inflation at 3.6%, the lowest CPI that we are seeing in 3 years now. Yeah, government has done a tax cuts in the budget that will help consumption or revive consumption. Finally, the government has announced, the Prime Minister has announced the constitution of the 8th Pay Commission. Next year, sometime similar time, we'll have the Pay Commission recommendation in place. Going by the past trends, it will lead to an increase of 15-20% more income in the hands of over 4 million central government employees and defense forces. I can see all the stars are aligned for a recovery in consumption in the economy. Consumption is on a low base. Consumer stocks have underperformed in the last 5 years. the one sector which has underperformed in this bull market last 5 years when Nifty has gone from 7,500 to 25,000 is consumer stocks. I think it's time to go back into consumption stock. So whether you play directly through consumer stocks, for us, so we've bought in a lot of consumer stocks across discretionary and staples. We also play consumers through consumer banks. For us, for me, HDFC Bank is a play on consumption. 1 out of 5 cars on Indian roads is sitting on balance sheet of HDFC Bank because they have 22% market share in India's auto loan industry. So 1 out of 5, whenever a car is sold, 1 out of every 5 cars is funded by HDFC Bank and it's sitting on their balance sheet. So if passenger vehicle sales grow in India, HDFC Bank will be a big beneficiary of it. 16% of credit card spends are funded by HDFC Bank. So 1 out of 6 rupees when you and I spend on our credit card, the money is spent through HDFC Bank network and they make money out of it. So HDFC Bank is very much a play on consumption as much as it is on the economy. And it's a great consumer play across a lot of segments of the economy in terms of consumption, passenger vehicles, on other segments of the economy as well. So I feel extremely, after a gap of 5 years now, I'm feeling positive or good about one, recovery of consumption, and more importantly, consumer stocks, which were very expensive 5 years back. Last 4 years, Hindustan Lever stock return is 0. Earnings have grown by 40%, stock is flat. Okay, so last 4 years, we've seen a valuation correction. A lever which was 75 P in 2020 now is 50 P 1 year forward earnings. So the valuation is corrected by 40%. And similarly, the story with a lot of consumer stocks. So I probably find consumer as a sector very well placed. I think one of the leading sectors which will drive this bull market from here over the next 3 years. Indian consumers will lead the front. Consumer-oriented businesses, whether they are direct consumer companies, let's say, I'm just saying, and the caveat, we own United Spirits. We think people will have more liquor, so United Spirits should be a beneficiary, or it could be an HDFC Bank. Okay, but consumer-oriented stock, consumer-driven businesses will do well. So that's a big theme for me, if you ask me. And as I said, I am buying into consumption after 5 years now.
Quite an insight. What is your view on IT sector? Because that has also not performed in last bull rally, and maybe it looks like it's like still struggling. It's making maybe new bottom.
Actually, the world is very volatile. In the last 6 weeks, a lot of things have actually changed in the world from a global perspective in terms of how world will evolve over the next 3 years. I'm saying 3 years because Trump, I'm presuming in the 4th year, he'll be ineffective. So at least the first 3 years of his term, he'll still be effective. By the 4th year, I'm hoping the last year, because it's his last term, probably he'll be more interested in creating history for himself than running the country. But next, the world has changed in terms of outlook over the next 3 years in terms of the agenda he's unleashed and the way he's going about. Obviously, it's apparent that this time he's a more prepared president, unlike last time where he was a novice in office. And he has a team. Last time he was struggling with his team. This time he has a team in place. So he will get he will make some headway in terms of his road ahead. So the point I was saying was, coming back up to IT, start of the year, I was very positive on IT. I thought because US economy is doing pretty well, IT spends have been pretty low. If you talk to or listen to the top 500 companies in US, which is where 60% of the global IT spends come from, then all these companies were looking forward to increasing or accelerating their IT budgets and IT spends because they're not spent. They've conserved resources in the last year and they were thinking to spend this year, kind of a thing. But now, because of this uncertainty which Trump has created around the US economy and everything else, these companies have again gone back in a somewhat of cautious mode in the last 3 or 4 weeks. In terms of when I listen to the commentary or read to what these companies are saying, they again saying, no, we want to hold back spends. So I think the recovery which was expected in IT sector has got pushed back. I still remain positive, but all I'm trying to say is I was expecting a recovery in the IT sector starting, this financial year. But at least that recovery now is certainly not happening in the first half of the financial year. So it's pushed back now. We have to see how things play out, whether we get a recovery. So I certainly think that there are a lot of latent spend which are pending there, which are there in the system, which companies want to spend to upgrade their IT. But they've been holding that back. They were supposed to be unleashed now because last year, calendar year 24, the last 6 months, the uncertainty was around US elections, that they wanted the elections to be behind and all of that and see who the new president is, what his policies are. Now you got a new president. He's created a new level of uncertainty in terms of the change of direction, change of course. Meaning, if you talk about auto companies in US, now with the imposition of tariffs that is imposed on auto imports from Canada and Mexico, those companies are more busy managing their supply chains because they have 30-40% of the supply chain which comes from Canada and Mexico, and these are auto companies who work on a very efficient supply chain. It's a just-in-time supply chain, so they don't keep inventory, they don't have warehouses. Now they'll have to at least they've stocked inventory for next 3 or 6 months, and in the next 6 months they'll have to rework their supply chains to reduce their input. So now they've got busy with that rather than focusing on IT spends. So a lot of these things are taking bandwidth of companies because they have to focus on some other things. So which is why I think the IT spend, which were to be unleashed, probably has gone further pushed back. So I still think Indian IT companies are reasonably well placed. I think there is a big surge in IT spend, which is waiting or pending to happen. These are latent, which has to happen. It cannot be denied because the technology has changed so fast in the last 3 or 4 years with evolution of AI and all of that, that companies need to adopt, companies need to implement, companies need to reorient and reorient their systems and upgrade their systems and spend on new technology. Otherwise, they'll be left behind and they'll be challenged by new companies, which they will not allow to do that. But I think that recovery in IT sector is pushed back. I was expecting next year. I don't see it's happening at least in the first half of the next financial year. So it's pushed back to later part of this year or probably next calendar year. So if you ask me from a slightly more medium-term perspective, take a 3-year view, I still continue to remain positive in Indian IT companies, because they're very well placed. But yes, we need to acknowledge and concede the fact that given what has happened in US, the recovery in IT sector is pushed back by at least 6 to 9 months. But I would still say for investors having a longer term time horizon, from our point of view, for example, we invest with a 3 to 5 year time horizon. So when the underlying fundamentals are good and when companies correct because of short term disappointments, for us that creates an opportunity. We use times like this to invest in these kind of companies because we know over a 3-year period there will be a recovery and these companies will benefit out of it. And this in a way gives us an opportunity to buy some of the good businesses at attractive valuations. And that is how you buy good companies, when you have to buy things when everyone else is selling, right? That is the time when you get the most attractive valuation. The highest level uncertainty creates the most attractive valuations. So you have to buy non-consensus things, right? 2020, I'm just giving an example, Kamal. 2020, when we were coming out of COVID, everyone was extremely bullish on consumer stocks. And because the 5 years before that, consumer stocks were the best performing stocks, the likes of Asian Paints, Pidilite, or whatever you call it, right? Or a Bajaj Finance, a consumer finance company. And we took a view, we could see the future next 5 years, and we said consumer stocks will not do well. Because government is saying post-COVID to revive economy, they will focus on reviving investment cycle. So the government is changing the direction. Consumer stocks are extremely rich in terms of valuations. Risk reward is unfavorable. On the other side, investment-oriented stocks were very cheap in terms of valuations. And government said they want to revive investments. And all these companies were talking about seeing higher growth in their business. So we completely sold our consumer portfolio and we went into industrials, right? And they were unloved at that point of time. They were unpopular. What I'm trying to tell for the benefit of all the viewers is buying what is consensus or buying what is popular most of the time does not make you money. Yeah, because what is popular is already priced in. It's priced to perfection. There's no returns left for you on the table. And to begin with, when you're buying some things slightly, if you want to buy things at an attractive valuation, you have to buy them slightly ahead of the crowd, ahead of it becoming consensus. And then when you're buying ahead of consensus, obviously it's you're buying something which is unpopular. But these are great companies. You're buying great companies. Today, consumer stocks, because of they've underperformed the last 3 years, no one wants to buy consumer stocks because people say the last 3 years return is zero. But this is the time to buy it. So all I'm saying is from a longer term investing perspective, one is to think. So other thing that always works for me is we think in terms of time horizons of 3 to 5 years. We don't think about the next 2 months, next 3 months, or next 1 quarter or 2 quarter. We are always, because we are buying businesses, we are making long-term investment basis, deep fundamental understanding and research on these companies. We are taking a view on these companies over 5 years, 10 years kind of a thing, And at this point of time, I find consumers as very attractive, exactly opposite of what was my view on 2020. So similarly with IT, probably the next 6 months IT stocks might not perform, but I'm saying if you're an investor with a 3 to 5 year time horizon like us, this is the time to be buying into IT stocks and sit on them for the next 3-5 years. Over the next 3 years, you will make very healthy returns.
Any new sectors, from bottom, which you think will emerge as a beneficiary of this entire challenging, I would say, landscape, which is kind of emerging? Because all these things we are aware of. We are like, like you mentioned, something which is yet not known is investable, because the meaning of investment is to kind of, see in the future, right?
Yeah.
So from that point of view, any new sector which you kind of see in the future, which makes sense, which will emerge from the bottom?
Sure. Very good question, Kamal. India, friends, from an investor's point of view, I think India, after US, the second most exciting place to do investing is India. Because given our demographics, given our technology adoption, things are changing so fast and so rapidly in India that you have huge amount of opportunities. India is changing very fast because of our demographics. Every 10 years, India is changing very differently. 10 years back, none of us were using UPI. Right now, UPI is a part of our lifestyle for all of us in terms of using whichever way, whether using Google Pay or a Phone Pay or a Paytm, but UPI is part of our lifestyle, and that has created huge value in whatever business we do. 10 years back, Zomato is 10 years old. 2013, Zomato was founded in 2013. We were not used to food delivery. Now, not only food delivery, we are used to quick commerce. Right? I think I'm a perma bull on tech, internet and tech. I think 20 years out, the new Reliance Industries of India, the new Tatas of India will emerge from disruptive technology, from whether it's fintech, consumer tech, medical tech, whichever form of tech you said, health tech. But I think the new conglomerates of India, or some of the biggest companies of India, will emerge from technology and disruptive technology. And it's very exciting. Having said that, for every one company that will succeed, there will be 50 which will fail. That's a normal rule in business. In business, success is only 2%. 98% is failure. Success rate is very low. So one has to be very careful in terms of what you're buying. Just because tech will do well does not mean all tech companies will do well. The fact is that 98% will fail. So one has to be very careful in terms of what you're buying. But let me give you an example. Okay, I think if you look at today's consumers does not go into a bank branch. They do all their banking and financial transactions on their phone, whether it's broking, whether it's depositing money, whether it's transferring money, all of that they're doing from their office, either on phone or through technology. I think one of the top 10 finance company out of India in 15 years time from today will be a fintech, will not be a traditional bank. Now, obviously, there are a lot of companies out there, few listed, few are still unlisted. They will get listed in the next few years. But I think the largest, amongst the top 5 or top 10 financial companies of India will be a fintech company. I'm a perma bull over the next 20 years on technology and disruptive technologies. A lot of companies are listed. Many more will get listed. Classical example, you took a consumer tech. Hindustan Lever, just about 4 weeks back, bought a small company formed out of Jaipur called Minimalist for 3,000 crores. I think some 3,000 crores odd they're paying for it. It's a small company with about some 250 crores of revenue or something like that, run by a small team out of Jaipur. Because Lever realized or acknowledged that what Lever, such a large conglomerate with so much of cash on their balance sheet, they can't do. This small bunch of guys sitting out of Jaipur have done it. Money cannot create business. You need people, you need technology, you need ideas, you need execution. And all of that cannot be solved with money, always. Money can help, but it is not the solution to all your problems in business. Otherwise, only the rich, biggest companies will keep growing, but that doesn't happen. So I'm saying a small bunch of guys sitting out of Jaipur could challenge some of these companies, and Lever could clearly see that potential. It's good that Lever acknowledged that and acquired that company, because they realize and acknowledge that they can't do what these guys are doing. So I think a lot of these things are going to happen. I feel very excited. One, about, as I said, about this whole technology as a space and disruptive technologies, including technology, be it food tech companies, Zomatos, and whatever others, fintech. We own Paytm in our portfolio. Let me acknowledge that. I am positive or constructive on that company. It has had somewhat a volatile journey in the last 18 months, but I still continue to remain positive. and all of that. And there are many more technology companies which are evolving, we own. So that's one I feel pretty positive about. Second space I feel extremely excited about, Kamal, is CRAMS. I think India will become the pharma outsourcing and manufacturing capital of the world. Just like we've become the IT capital of the world, we'll also become the pharma research and contract manufacturing capital of the world. We're still amongst the top 5 in the world, but we're still not the leader there. China is much bigger than India, but I think we'll take over China in the next 10 years because the kind of resources we have available here in terms of our ability to every year generate few lakh postgraduates and PhDs in chemistry and biology. And at the cost which these people are, the arbitrage we have in terms of a cost of a PhD in biology or chemistry in India is 1/3 of the same resource in US. And there's a scarcity of resources there with PhDs. In India, we have them in abundance. So I see more and more pharma research and manufacturing will shift from US and Europe to India. And I again somehow feel that in that industry, we have after 20 years, that industry has been around for 20 years in India, we have reached some sort of an inflection point where some point of time we'll see a hockey stick growth in the next 10-15 years. Something similar happened with IT. IT industry was around in India from 1984. They hit an inflection point around Y2K in 96-97 when the Y2K projects were there and all of that, and then after Y2K the industry took off. I think in the CRAMS industry we are the industry has been around for 20 years. We are somewhere closer to an inflection point where the industry will have a J-curve growth in the next, and then for the next 15-20 years it will have a very exponential growth curve. So if you really ask me, sitting where I'm sitting, and the way I look at things from a slightly more longer term perspective, I feel really excited about these two things where I'm willing to put my money and take a 20-year view and just sit tight on them. I think there's huge amount of wealth that is to be created in both these spaces over the next 20 years.
Sure, sure. Pankaj, you also mentioned in the beginning that investment, makes most sense when things are ignored because everybody is selling. Only then you can be buyers.
Yes.
But that is, how do you hence, rationalize the valuations of some of these new trends? Because all these names that we, mentioned, like all these new age technologies, fintechs and all, when we check their P's and their valuations on, screeners, they kind of show like infinite valuations. I understand that they cannot be seen from PE perspective only, but you have to see it differently. But as a fund manager, when you manage public money with a long-term horizon, how do you convince yourself, to select one versus the other?
Well, we are, as investors, we are conservative. While we are always focused on investing into, our natural DNA is growth. We are always looking to invest into growth and high growth companies. So we're always chasing high growth companies, but we also do our due diligence in terms of we want sustainable high growth. We want companies which will have enduring growth for the next 20 years, next 10, 20 years kind of a thing. Because investors, we are very long-term in our approach. We are not thinking, as I said, we're always thinking in terms of 5 years, 10 years, 15 years. We are not thinking in terms of 1 quarter, 2 quarter and all of that. Quarter for us is a too short a time meaning. So we're always chasing high growth, but at the same time, we are fairly conservative when it comes to valuations. So, and we are happy to wait for our, for our time for companies to get to our closer to. So we have our own framework of valuation. For us, the principal framework of valuation obviously is DCF, cash flows, because eventually as owners of the business, we want our companies to generate cash. And like a, meaning, I'm a banya, so like a grocer, we want cash. Our businesses, or in that we invest to generate cash. And we want those businesses to give some part of cash back to us as shareholders in terms of dividends or share buybacks, and probably use some part of that cash to fund their future growth and so on and so forth. So one, as investors, while there are different frameworks, as you said, for valuing some of these new age companies or companies which are early stage of growth cycle, but for us, the primary framework is DCA for value of cash flows. So if we can project or predict cash flows of these companies over the next 5, 10, 15 years, and then discount them back to what the value of those cash flows are today. And we think eventually, I think while markets valuations can go higher or lower, but eventually it's my firm belief, and we have seen, we always keep seeing this over a long period of time, eventually stock prices gravitate towards their fair value, right? And the assessment of their fair value is the DCF value or the value of cash that a business can generate over its life cycle. So the primary job for an analyst or a fund manager like me or my analyst team is to be able to judge. Let's say if you look at Zomato, our primary job is to judge what kind of cash flows Zomato can generate over the next 20 or 25 years. And then whatever cash Zomato will generate in terms of cash for the next 25 years, what is the value of that today? What is the fair value of that? Stock can be above or below fair value. So our framework is that we try to judge that fair value of business. We try to make an assessment of what the growth potential is, what that company can execute, and what kind of cash flows, profits, and more than profits, cash flows this company can generate over the next 20-25 years. And what is the value of, if I were to buy 100% of Zomato today, what is the money I'm willing to pay? What is the fair value? Then I can decide whether I want to overpay or underpay. The first question is for me to assess what is the fair value of Zomato. Zomato का स्टॉक प्राइस तो बहुत डिफिकल्ट होता है जज करना. एक दिन 200, अभी 300 था, अब 200 हो गया. रोज 5% ऊपर या नीचे होता है. बिजनेस की वैल्यू तो रोज 5-6% ऊपर नीचे नहीं हो रही है. बिजनेस की वैल्यू तो जोमेटो 300 से 200 हो गया, तो बिजनेस की वैल्यू तो 1/3 नहीं घट गई 4 महीने में. ये तो स्टॉक मार्केट की वॉलेटिलिटी है, बिकॉज वो आपके मेरे जैसे इन्वेस्टर्स बाइंग सेलिंग कर रहे हैं, वो पैनिक में कर रहे हैं. किसी ने प्लेज करके लिया हुआ है, किसी को इंडिया से एग्जिट होना है, किसी फॉरेनर को, पर अंडरलाइंग बिजनेस जो है तो स्टेडी है. तो फर्स्ट थिंग व्हेन यू आर बाइंग स्टॉक्स, यू हैव टू असेस कि उसकी वैल्यू क्या है. Then we can judge कि मैं इस प्राइस पे लूं कि नहीं लूं. So we try to arrive at what I call the fundamental value or the fair value of a business, and then we take a call in terms of high growth. Sometimes we want to buy businesses at or below fair value. Sometimes we might buy even above the fair value, but that is only after, if we think over the future, we can still make a money. But our primary objective is to assess the value of that business. कि कल अगर मेरे पास पैसे हैं, मेरे पास $10 billion बैंक में है, मुझे पूरी कंपनी खरीदनी है, तो मैं क्या प्राइस पे खरीदूंगा. एंड व्हाट प्राइस अप्लाइज टू अ पर्सन हु इज बाइंग 100%, द सेम वैल्यू अप्लाइज टू अस एज अ माइनॉरिटी शेयर होल्डर, एज अ स्मॉल शेयर होल्डर आल्सो. बिजनेस की वैल्यू तो उतनी है. वी कैन पे प्रीमियम और वी कैन आस्क डिस्काउंट, दैट्स अ सेपरेट थिंग. सो आवर फ्रेमवर्क, कमल, इज वी आर वेरी फंडामेंटली ओरिएंटेड. वी थिंक वेरी लॉन्ग टर्म. इसीलिए, एंड बिकॉज वी आर ग्राउंडेड, सो डीपली ग्राउंडेड इनटू अ रिसर्च प्रोसेस ना, तो ये मार्केट 20% ऊपर नीचे होता है, उससे मतलब सम ऑफ दोस थिंग्स मेनी अ टाइम्स वी आर एंटिसिपेटिंग कि अगर जोमेटो की हमारी फेयर वैल्यू 200 रुपए, स्टॉक 300 रुपए जब हो गया, तो हमें पता था कि यार ये कभी ना कभी गिरेगा, बिकॉज समवन इज स्मार्ट इनफ. वी सोल्ड आवर जोमेटो एट 250-260 बिकॉज इट वाज 25% अबव द फेयर वैल्यू. वी रियलाइज कि अगर हमें पता है तो देयर विल बी इनफ स्मार्ट पीपल इन द मार्केट हु विल कम एंड सेल, बिकॉज दे नो कि वो स्टॉक इज ओवर वैल्यूड, राइट. तो जब व्हेन स्टॉक फॉल्स, वी डोंट गेट पर्टर्ब्ड, बिकॉज हमें पता था ये तो होना ही था, because the stock was at such a huge premium or overvalued to that extent above its fair value by such a wide margin कि ये तो गिरना ही था. So मतलब, I'm sorry, I don't want to make fun, but many a time जब stock price गिरते हैं तो we feel good about it. I'm sorry, I know it's painful for a lot of people, but we feel good about it because we were expecting that, we were anticipating that. When markets were at 26,000, I did one interview in December. I said index can go to 22,000. Because the fair value of index was 22,000. So, and luckily we got there. मेरे पास कोई, I can't forecast, but we do financial modeling. ये simple financial modeling है, जो कि I'm sure a lot of financial analysts are doing, हमारे अलावा भी. But for us, we are very fundamentally grounded into our whole research process, and we just follow our fundamental research. उसके अलावा ये न्यूज, ये खबर, वो खबर, some Trump saying something, some other politician saying something, ये सब मतलब वो नारायण मूर्ति ने एक बार बोला था 96 में मुझे, कि बोला at Infosys we believe in numbers and we trust in God and everything else is a hearsay. So we have faith in God and we trust numbers. That's it in investing, और कुछ नहीं, nothing else comes in between other than that.
Sure. So the only, I would say, the other side of the argument would be investing in some of these new age companies, maybe when they are unlisted, when they are you are entering early, and we're creating a diversified portfolio through maybe a category 2 fund. Obviously, makes a sense, because the world is evolving in Indian context. There are a lot of new age businesses, like the example you took of minimalistic and all, they will take over. But from the point of view of listed space, when you invest in some of these companies, we see that when there are competitors of Asian Paints, well-established company like Asian Paints, which is a profitable business for so many years, a new news on competition comes, stock cracks 30%. The same happened with Polycab. The same happened with many other businesses. But on the other side, when you invest in the listed space, in some of the loss making, or maybe, which are like trying to discover how to make profits, the names like Zomato, I'm assuming you would be buyer at Zomato and you will be happily buying Zomato. Like you mentioned, you were waiting for price to correct from 300 to 220. Now you are a long-term investor in it. Over time, it will gradually discover its kind of positioning. As it creates its positioning, now company like Zomato will also face a similar competition like Asian Paints has faced or Polycab has faced. But company like Zomato is like too expensive in terms of valuations versus some of these other well-established, profitable companies which are sitting on cash reserves. So how would you kind of ultimately give yourself so much conviction to hold on for long term?
Yeah, so good question, Kamal. The key here is your ability to understand that industry and your ability to forecast the future growth of the company. So as you rightly said, let's say in case of paint sector, it's a sector with 3 or 4 organized players dominating the sector for the last 30 years. Now all of a sudden we have 3 new players. Birlas are there, JSW is there, and one more player is there. So the competitive landscape will change, the growth will moderate, and all of that. And SNEF, I still think Asian Paints is a great company. Their competition has been there in the past also. New players have tried and come, and Asian Paint has maintained their dominance. So they're very good at what they do. You look at the history of Asian Paints over the last 30-40 years, it's an excellent company. But in the past also, Asian Paints, when we talk about, let's say, pricing, valuation and a P multiple, Asian Paints are traded at 18p or 20p. So, and then the same Asian Paint in 2020 was trading at 70p, maybe now it's at 40p or something like that. So companies go through this cycle of P re-rating and de-rating depending on P is based on the next 1 year growth. And which is why I say the fundamental value of the business is through cash flows of the business over a 10-20 year period and your ability to forecast that cash flow. Because P तो क्या होता है, कम ज़्यादा होता रहता है. 5 साल पहले लीवर का P 70 था, आज 50 है. एशियन पेंट का P 70 था, अभी आज 40 है. पर 20 साल पहले 15 साल पहले आप देखोगे तो एशियन पेंट्स का P 20 का था. तो देन 20 सही है कि 70 सही था कि 50 सही था, हमें नहीं पता है. मतलब we can have an argument, but your judgment, my judgment is always debatable and all that. The reality maybe is somewhere in the between or whatever it is. So which is why I always say that we always use cash flow to value a business and predict cash flows. Also then it evolves. जैसे Zomato जैसी company, I'm just giving an example. Today Zomato has 4 crore users on their platform using Zomato. Meaning in a country like India, 140 crore, 1.4 billion people, Zomato can easily have 10-12 crore customers, right? HDFC Bank today has 12 crore customers, right? So if 12 crore customers are banking with HDFC Bank in some form or other, or if 400 million people in India are watching IPL matches, then why cannot Zomato have 100 million customers? Today they are 40 million, 50 million or something like that. I think that can certainly happen, and that will happen. So then there's a story about penetration. In terms of penetration will increase, Zomato will have more customers, and customers will be using more and more Zomato and all of that. So it involves forecasting, assumptions, and doing all of that. So we bake that into account. As I told you, we always tend to chase high growth companies because eventually shareholder returns are a function of the bigger pool of cash flows that companies can generate. So high growth company will generate more cash flow versus a low growth company. Very simple, over the next 20 years. Right? So we are always gravitating towards that. And once हमारा beauty ये होता है कि once we have the fair value of the business, हम बैठे रहते हैं, हम वेट करते हैं वो स्टॉक अगर ओवरप्राइज्ड है तो वो फेयर वैल्यू पे कब आएगा, तब तक हम इंतजार करते हैं, हमें कोई जल्दी नहीं है. सी द पॉइंट इज हमारे बिजनेस की ब्यूटी ये है, एज इन्वेस्टर ऑल ऑफ अस हैव दैट प्रिविलेज. देयर आर 2200 listed companies in NSE. My portfolio is 25 companies. I have to buy 25 companies, 1% of the listed universe. So that means I have to reject 99% of the companies, either because of growth, either because of valuation, either because of corporate governance or some other issue. So वो 25 कंपनियां तो मिल जाती है आराम से at any point of time. इंडिया में actually, honestly speaking, as investors, we are spoiled for choices. The number of good companies available at reasonable valuation for all of us at any point of time is far higher than what we can invest. So उसमें से then we select. So companies which are closer to our fair value or where we see the risk return very attractive, buying price very attractive, which is where we tend to go and invest. I'm just saying Paytm got listed at 2000, 2100 IPO. We bought it at 500, so we had to wait for 15 months for it to get there. Despite that last 18 months that we've been invested, the stock has had a lot of volatility. But we've been sitting patiently now because we have taken a 5-year, 10-year view on Paytm. Okay, we bought it 500, it went up, it went down, it has some regulatory challenges and all that. But all through the volatility, we have a fundamental fair value in place in terms of what we expect Paytm to deliver in terms of growth over the next 10, 15 years. Yeah, and we are sitting on it. So obviously, I said one has to ride the volatility. But once you know what is the fair value of the business and you think the business is, then we'll keep tracking the business. If the business is in the right direction, then just wait for it. Eventually, markets are very smart. Eventually, every business stock price will go closer to its fair value because there are very smart people working in this market. Because we have so much of foreign money, the best of the global brains is working in Indian stock market because they are taking decision of buying, selling for the biggest of the FIIs. Right? So there is no dearth of intellectual capital that is available in Indian market or that is working in Indian market. So then stocks cannot remain mispriced for a long period of time. Fair value stocks will eventually go towards their fair value. So as long as we can understand what is the value, हम कोई भी चीज खरीदते हैं तो हमारे लिए फर्स्ट इंपॉर्टेंट चीज हम समझे उसकी वैल्यू क्या है. हम शॉप में भी जाके कुछ खरीद रहे हैं, अपैरल खरीद रहे हैं या कुछ गुड्स खरीद रहे हैं तो हम उसकी वैल्यू समझने की कोशिश करते हैं, राइट, इसकी वैल्यू क्या है. सो लाइकवाइज यहाँ पे भी हमें बहुत जरूरी है समझना कि हम जो कंपनी खरीद रहे हैं उसकी वैल्यू क्या है. एक बार वो समझ में आ गया, देन डिसीजन मेकिंग इज वेरी सिंपल, वेरी सिंपल. Then you just have to be disciplined, and which is what we practice all the time.
Sure. So let's move on to the subsequent, aspect. So when it is a context of, trying to identify a company from the point of view of mispricing, I'm sure more opportunities are available in the mid cap and small cap versus large caps, because large caps are like already explored. But there is this narrative which goes on in market, especially in these days. The large caps are relatively far more attractive. Mid and small cap will see more correction because, again, fund managers are maybe when they are coming and giving interviews and talking to, I would say, TV anchors, they are trying to again focus more on price and saying stay away from small and mid caps and invest in large caps. Because if mispricing is if mispricing or trying to invest in future growth is the way to get returns, then ideally one should invest in mid and small caps more than maybe in large caps.
This year could be at the index level. I think the large cap index can do better than mid and small cap index this calendar year. Something similar happened in calendar year 22 also, when the Nifty index was up 5% and the Nifty small cap 100 index in CY22 was down 13%. So while large cap and mid cap give higher returns than while the mid cap and small cap gives higher returns than large cap, but there will always be a mean reversion where in a particular year where large cap index will give higher returns than or better returns because mid caps and small caps are that much more overpriced. So I think this year could be a year of mean reversion where the Nifty large cap index can give higher return than mid cap index and small cap index. And as I said, something similar happened in 22 as well. Over a medium term to long term, yes, mid and small cap will give higher returns. The only caveat there is, friends, that a lot of mid and small cap companies fail. They go out of business. The failure rate is as high as 30-35%. So if you are invested into one of those companies which fails, your capital goes down to zero because that goes down to zero. So mid and small cap stock selection becomes even more important. In large cap, the business, because these are large businesses, failure is very low. Large companies do not fail so easily because नहीं तो वो large ही नहीं बनते. In the process of becoming large, they've gone through various challenges and despite that they become large. So in that sense, yes, mid and small cap will give high returns. The only thing we should always remember or keep at the back of our mind is that these higher returns are coming at a higher risk. Because some of those will, even the best of the investor, even we, when we invest in mid and small cap, on a 10-year cycle, one or two of our investing companies fail. Because these businesses, at times, they are not able to deal with external challenges. Now Trump is doing something, the world is changing so fast. Some companies might not be able to cope up with that and their business model become vulnerable and all that. So yes, high returns, but high returns at higher risk. Risk is higher. So we need to acknowledge that is the only point I'm saying. And because there is a higher risk, whenever markets fall, like they fell in the last 6 months, mid and small cap will also fall higher. Stocks will fall higher because they are more expensive than large cap. And the growth expectation there is much higher. If there's a growth disappointment, those stocks will fall much less. So which is why every time markets fall, mid and small cap always fall higher than the large cap. So yes, on a 5-year, 10-year basis, they'll give higher returns, provided you invest in the right companies. and the risk is higher. Is the only point. Otherwise, I agree with what you're saying.
Sure, Pankaj, sure. So we are moving to the last, I would say, conversation, last question. I give disclaimer for everyone who is watching or who may watch this video later that whatever discussion we have done is only for education purpose. Any stock discussion that we have done, it is like not to be construed as any advice. Everyone should do their own research before, getting into any stock or any such, I would say, name that has been discussed. So we discussed about Zomato. Zomato is a one interesting story which is definitely building up, and which I also firmly believe in. And you also mentioned about right valuation. It will converge to right valuation sooner or later. So you mentioned about you entering at Paytm at certain price, right? So what is the price at which you entered in Zomato, and what is the right price you think as a target for it? In just for education, from your knowledge perspective.
Yeah, sure. We bought Zomato around 54, 55 rupees post the IPO once the stock fell and all of that. Also, what is happening with these companies now, what I've realized, my experience, I'm telling you, the business model is evolving. These founders are also first generation entrepreneurs. They're very aggressive guys, very hardworking guys. So as the environment changes, they're changing their business also very fast to adapt to that environment. Something similar happened in Zomato also during the course of evolution in the last 10 years, and they've changed their business model. Recently they've changed them. They've added new lines of business, right? They've launched a new app called District for events, and that's supposedly should become a big category, because in India we've seen with some of the recent events like Coldplay and all of that, the way India is going crazy, the Gen Z is going crazy, and all of that. That means there's a huge demand and market out there, and all of that. So it's a new business that they've launched, and I think over a 10-year period that will become very valuable and all that. So that was not part of our plan, which we have to now incorporate, which we are in the process of incorporating, I would say, on all that. We bought Zomato at 52, 55. I think the long-term value of Zomato is still significantly higher than where it is today. But having said that, given the fact that the stock has done very well, and I think the stock is fairly priced today. The stock is not mispriced today now, what it was. Also, you see, when Zomato got IPO, they were not charging any platform fees. Now they are in different cities, they are charging platform fees between 5 and 10 rupees. And customers like you and me are very happily, everyone is happily paying that. People are not objecting to it. So the businesses are also exercising pricing power, right? Because as a customer now, once you're used to it, you only have a choice between 2 or 3 platforms, Zomato, Swiggy, and all the platforms are charging. So businesses also start exercising pricing power at some point of time when they realize that they've reached some sort of a maturity in terms of customer penetration, customer adoption. Then eventually businesses, the dharma of a business is to make profits for the shareholders, to serve customers. Obviously, that's the first dharma, but in the process, make money. If you're not making money, you're running it for charity, right? So business is not supposed to be charity. Charity is separate. So business eventually has to make money by adding value to the customer and all that. And each business exercises that pricing power at different points of time in their life cycle. So we've seen that change happen and all that. So we bought Zomato at around 52 rupees. We thought it's damn cheap given the kind of, and we had that hypothesis at that point of time. Tomorrow if this charging 10 or 20 rupees as platform fees, customers will happily pay because they are adding certain meaningful value to the customer in terms of all of that. I think if you really ask me, probably from a near-term perspective, the next 18 months, Zomato is close to fair value. But if you take a 10-year view, I still think that the stock can do a 15-20% CAGR return, compounded annualized 15-20, somewhere between 15-20% compounded annualized return from here over the next 10 years, which effectively means the stock can be 4x, 5x, 4x from here in the next 10 years. Meaning I'll not be surprised in that sense. Unless only one caveat here again. In technology business, we have to be watchful of new disruption. If someone else comes and does something which disrupts Zomato's business model or something like that, so then we'll have to take that into cognizance, which is not there in the framework. So one has to be vigilant in that sense, agile in that sense. But I'd see, take a 10-year view, and Zomato can comfortably do a 15% CAGR shareholder returns from here, and 15% compounded over 10 years, meaning the stock can go 4x from here. Maybe not in the next 18 months, but 10 years, I think that's possible.
Sure. So, we have kind of, come to the end. So no more discussion on stocks, sectors, view, perspective. But generally, the biggest elephant in front of us is deglobalization risk and, the tariffs thing. You have fundamental viewpoints on everything, like very long-term perspective. like whether be it on India, when you say you have complete faith on India, I kind of 100% buy that, or be it sectors like turnaround of maybe now consumers from the bottom as a long term opinion. So likewise, you also mentioned briefly that eventually globalization, what he's trying to do is going to pre World War II era, or maybe if I say pre 1991 era, like India as an economy was also into socialistic economic system. After that, we adopted globalization and privatization, and we know the differences it made to our economy. Exactly what Trump is trying to do today. So ideologically, fundamentally, how do you see this entire thing will shape up in long term? Over say long term, like over say next 4 years. 4 years is not very long term, I know, but that's the term that is in front of us.
I got your point. I'll give you a perspective. I think whatever Trump is trying to do is an aberration in the long term trend. The long term trend for the world, I still firmly believe, is about more integration, more globalization, more alignment. Trump is a short term aberration. When I say short term, this is a 4-year aberration that the world will witness or live through it. And I think so. This is an aberration that is happening in the world. I think if you ask me, next 10 years, 20 years, the direction for the world is higher integration. That's the only way. Eventually, all political leaders have no choice but to work towards world prosperity. Today, in this technology-driven, hyper-connected world, no individual, no company, no business, no country can survive or thrive or prosper in isolation. No one can be an island in isolation. If you are, you will not prosper. You might be the richest country in the world. You might be the most powerful country in the world in terms of your defense capabilities and all of that. You might have the biggest and the best scientific and technological know-how in the world. Yet, if you want to remain in isolation with the world, you might represent 30% of global wealth, but you represent less than 5% of humanity, mankind on this. आप टेक्नोलॉजी बना दोगे, खाली 5% में लोग यूज करेंगे, 95% तो वर्ल्ड अडॉप्ट ही नहीं करेगा, तो क्या करोगे आप उसका? चाटोगे उसको? So obviously all of us know, meaning knowing whatever little we know about Trump, that he's a maverick. I think whatever he is doing is an aberration. It's not aligned to the forces of nature. 10 years out, I think the world will be far more integrated, far more globalized than what it was when Trump started his tenure. Short term is aberration, we have to live with it. How much damage or how much reversal he does, we'll have to see. But yes, it's aberration. But 10 years out, I think the world will be more integrated. That's my view. The long-term trend is very much intact. No single person can change this. Any country which try to do it, that country will suffer the consequences, irrespective of being the richest or the most powerful.
Sure, Pankaj. So you are indirectly saying that whatever this mispricing comes out as a result of this aberration is a opportunity for fund managers like you to patiently wait and enter into the kind of stocks or sectors that you are kind of wanting to enter in. And because the long-term trend is intact, equity obviously inherently is a long-term asset class meant for investors who have a long-term horizon. Thank you so much for sparing your time, and this was really insightful conversation. And thank you everyone for logging in. If you want to do kind of more such particular conversations on your portfolios, you're most welcome to come to our platform, PMSAIF World. We have, very astute team of professionals who can kind of guide you and direct you to right fund managers. Like Pankaj, is one of those. And we are happy to kind of, guide you. You're most welcome. Thank you so much once again, Pankaj. And thank you everyone for logging in.